Okay. Ooh, let's see. What do I have here? Okay. Um, so the topic that I'm going to be going over today is due diligence essentials, the top things to look for during the due diligence process to avoid potential deal breakers and uncover hidden issues. You can spin that however you want. Due diligence essentials is completely fine. All right, let me get up my document here. And I should probably work on getting a better mic because my one at home is not that clear. This one is a little bit better, but it's just the MacBook mic, so maybe it works. Welcome back to the Multifamily Mindset podcast. I'm your host, Kyle, and today we're diving deep into a crucial aspect of every multifamily acquisition, due diligence. This stage of the process can make or break your deal, and I want to share with you the top things to look for during that due diligence period to avoid deal breakers and uncover any hidden issues. So, whether you're a seasoned investor or new to the syndication game, these tips will help save you some time, money, and headaches down the line. So, let's get right into it. First off, for those who are newer, let's talk about what due diligence actually is. Due diligence is the period where you're verifying the property that you're purchasing is in good condition, right? It's the condition that you actually expect, and there's no major surprises that are hiding under the surface. So you'll inspect everything from their financial records to the physical state of the property and how well it's being run by the current owner. Essentially, you can think of this as your chance to trust but verify. So let's start with physical due diligence. This is where you physically inspect the building, and it can uncover some of the most costly surprises. So, one, structural integrity. You want to assess the foundation, the roof, plumbing, electrical systems. These are big ticket items that can seriously impact your renovation budget if they need repairs. Bring in professional inspectors to ensure there's no major deferred maintenance lurking, as not all of us may be able to understand if there is any major deferred maintenance in some of these issues. For number two, HVAC systems, this is a huge one. You want to check to see how old the HVAC units are and whether they're properly maintained. Replacing HVAC systems can be a huge expense, so it's crucial to understand their condition early on. There's a lot of maintenance items, preventative maintenance really is what we'd call them in property management, to ensure that an HVAC system can continue to run for as long as possible. And we want to make sure that these things have been taken care of. Now, number three, water damage and mold. Oh man, water damage can lead to mold. And I personally know from my own experience with hurricane related water damage, like these issues can rack up, man, hundreds of thousands of dollars in repairs. Luckily, you'll have insurance to help out with that if a hurricane were to hit, but we can get into that another day with insurance premiums going up. So just look closely for any signs of past or present leaks, moisture buildup, or mold growth. Sometimes you can even tell when you initially walk into an apartment, just that different must feel that you get when you go in there. Now, we can get into the more entertaining part, the fun part, as I call it, the financial due diligence. So this is where you'll really dig into the numbers and make sure everything adds up. So we're going to want to check rent rolls and leases extremely carefully, right? You want to make sure that tenants are paying what the seller says they are. Check the leases to ensure there are no inconsistencies or concessions that might affect your income stream. And I can't stress this enough. The system might have a resident paying $1,000 in rent, but when they actually sign for about $1,400 rent, it's very specific numbers because I've seen it happen. Residents are not going to tell you, hey, I'm paying $400 less than I am every month or less than I signed for. So it's important that we're actually checking through all of the documents because this is potentially money that you would be missing out on, as well as really not being able to capitalize on any of this extra capital coming in the future just due to bad property management beforehand or just lack of audits that have been done. We'll also want to examine the T12. And you might think, well, we probably already did that before, for sure, ideally. But sometimes you'll get a T3 or a T6, and then you have to annualize it, estimate the numbers. So if we're on the lookout for any unusual spikes in expenses or income that could indicate manipulation of the numbers, that would really give us some clarity. Because sometimes sellers will cut back on maintenance to make the property appear more profitable than it really is. And whose fault is that to actually deal with now? Yours as the new buyer. Now, Lastly, what we also want to look at is just our CapEx reserves budget. So we want to see what CapEx reserves we'll actually need. Even if the building's in good shape, you may still need to set aside money for future improvements that fell outside of your original scope of work. So whether that's new flooring, updated kitchens, or improved amenities that you weren't expecting to do before, you might actually have to do that now. So you want to make sure it's budgeted for accordingly. And also, while you're in the area, I love to talk about this. I don't think it's talked about enough. Market due diligence, right? You can't forget about the market itself. If the neighborhood is in decline or the market has too much competition, that can spell trouble down the road. And you're already at the property, so let's just use this time to check out the surrounding area and just make sure all of our desktop due diligence that we did beforehand, right? Looking up rental comps, verifying what this market actually looks like. Now we can actually do that in person. So as I mentioned, rental comps, you're doing a proper analysis of the comparable rents in the area. So you'll want to verify the rents you're expecting to charge is in line with what similar properties you're getting. Ensure there wasn't some sort of regression or you had outdated information. And ideally, hopefully we undershot what your rental projections could be after checking out some of the properties nearby. You'll want to look at neighboring properties, and then all the properties that you had as your listed out comps. But when I say neighboring properties specifically, yeah, even if it's an A-class property and you're looking at a C-class to potentially purchase, still go and check it out, see what the differences are. Now, we'll also want to look at the employment trends, the data, and what that looks like actually in the area. I know we already asked ourselves, are jobs coming into the market? Are they leaving? What's the population growth rate? But do you actually see these growth factors in that particular neighborhood? These factors are key to understanding whether demand for your units will remain strong. Same thing goes for crime rates in schools. We want to check crime rates and the quality of local schools. And you might want to drive by those schools, kind of see what easiest access of routes is, because this can affect the tenant quality and retention that we have. With lower crime and good schools, you would tend to attract better and longer term tenants. Finally, we'll want to make sure that all your paperwork is in order. So a couple things to look at is, doing a title search. A lot of people don't think about this initially. However, a title search is very key just to ensure there's no liens or encumbrances on the property. One time I've looked at a property and it wasn't as large of an issue as we thought, but one of the major plumbers in the area actually wouldn't come out to service that property due to non-payments of contracts that they already had before. So that plumber would not come back out to that property. It was one of the larger companies in the area, but at least we had other ways to get around that. We had a different plumbing company that we'd be able to reach out to if we needed anything, which that relationship came from building that up with, the property managers in that area over so long. We'll also want to look at zoning and permits, right? So we'll double check the property zoning to make sure it's compliant with local regulations and that all necessary permits are in place. You do not want to get caught needing to rezone after the deal is done. Normally, that isn't something I see pop up as often, but it's always worth checking. Now, insurance policies. I mentioned this a little bit earlier, but get an understanding what the property's current insurance policies are and determine whether they're sufficient enough or you're going to need additional coverage. There's a lot that we can go into insurance. It's great to just make sure we're able to double check what policies we have covering us. So I know that's a lot that I mentioned, and due diligence can for sure feel overwhelming, but understand it's essential to protect yourself and your investors. By carefully reviewing the physical state of the property, digging into the financials, understanding the market conditions, you can avoid costly mistakes that set yourself up for success. Remember, this process is all about verifying that the property is what the seller says it is and covering any potential issues before you close. But thanks for tuning in. If you found this episode helpful, please leave a review and share it with others who are ready to think bigger. And if you have any questions about due diligence or multifamily investing, feel free to reach out to us. Until next time, thanks.